Hello everyone, welcome to Atomic ACCA's exam solving series, and in this video we are moving to section B of the SBR pre-mock exam for June 2025 session. Now in section B we know that there will be two questions again. It will be split into 25 and 25 and it can be from any part of the syllabus, so we can't exactly predict. So let's start with question number 3. Edison Company is the parent company of a group. Financial statements are prepared in accordance with IFRS and group financial year end is 31st December X7. Following exhibits are available. Share option scheme is there. Investment in associate is there. Okay. So first things first, we take the word processor. We take our requirements and we're going to copy paste everything. Copy, Control C and Control V, and we close this. And we have first question over here, it goes all the way till 12 marks. Second question over here, it goes all the way till 4 marks. Then we have question number B, we have B1 goes all the way till 6 marks, and question number 2 all the way till 3 marks. Okay, so these are the questions that we have. I'll just bold it up just to show that this is my questions. Okay, so here we can see this is using exhibit 1. Here we can see this is using exhibit 2. So we're not going to bother this one for the time being. We're only going to look at the exhibit number 1. So using exhibit 1 and in accordance with IFRS accounting standards, explain with calculation. So just like how we did the other questions, we're going to start off with the same way. We'll do the numericals, then reverse work it to the theory part. How Edison Company should account for the share option scheme and related deferred tax in the consolidated financial statement for year ended 31st December X7. So how about share option scheme and related deferred tax? So probably something about share option is there, something about deferred tax is there. Then part 2 is critically discuss whether deferred tax balance recognized in relation to the share option scheme reflects the definition of elements provided in the conceptual framework for. Okay, this is we have to connect it with the elements means asset, equity, liability, income, expense. So you have to connect to the explanations of that and then say it. But again, it's only for 4 marks, so you don't need very in-depth analysis. It's going to be very basic. But here we can expect some long calculations or long discussions coming up. So let's start reading the case study. On 1st Jan 20x6, so year ending was 31st December x7. So 1st Jan x6, 31st December x6, 31st December x7. So 2 years time gap is there. Edison implemented a share option scheme for its managers. Each of the 200 managers was granted 10,000 options that vest on 31st December x8. So what is the time gap? Don't think 8 minus 6 2. No. This is 1st of Jan, this is 31st of December. So x6, x7, x8. This is 3-year time period. And we are in the second year, 31st December x7. Providing that the rule is or the condition is managers must work until that date. So they have to stay for 3-year time period. That is the vesting date. Exercise price of the option is 8.5. Okay. Edison will benefit from tax relief on the transaction. Who is Edison? Okay, Edison is the main company. So Edison will benefit from tax relief on the transaction when the share options are exercised based on the intrinsic value of the share option. This is from that taxation chapter. There's a topic about share options where it's like a specific topic. They discuss about how when you have a share option, how it will lead to deferred tax and how you have to adjust and all. So this is the only place where you will see this word intrinsic value and how it is used to, how it is supposed to be used in the calculation. So we'll deal this later. That is supposed to be part of this one, second part related to deferred tax. So they're telling share option, it is the difference between exercise price and of the share option and the fair value of the share, meaning like the market price. On 1st Jan 20x6, that is the grand date, fair value of the share option was 2.80. Why grand date fair value is given? Because this is a share option given where you're going to give shares to the other party. Okay, when they are exercising it, they're going to get share, not cash. So this is an equity settled share based payment. In equity settled share based payment, you have to give, you have to calculate the expenses based on the grant date fair value and not the reporting date. So that's why we need this information very importantly. On 31st December X7, that is the current year end, fair value of one of the Edison share was 11.50. So this is the market value. On 31st December X7, that is the year end, it was expected that 90% of the share options would vest. Okay, this is number of people who are going to take up the, no, who are going to stay until the end of third year. And you're expecting this on 31st December X7. So it's like 2 years are done. At the end of 2 year, you're expecting that 90% of people would take it up in the next year. In the year ended 31st December X6, Edison correctly recognized the share option expense of 1792. So in the first year, total expense was 1792 million, 1.792 million in the consolidated SOPL. It also correctly recognized a deferred tax asset in the last year in relation to share option scheme of 104,000 with a corresponding credit to the consolidated SOPL. Credit to SOPL. Okay, you made debit deferred tax asset, credit SOPL 104,000. Why specifically deferred tax asset? Because from the IAS 12 chapter it's mentioned that when you have a share option scheme, it will lead to deferred tax asset. How it will lead to deferred tax asset, we'll discuss when we are doing the number works. The relevant tax rate is 25%. So now let's start the numerical work. It's quite straightforward. There's no much complications over here. What they've asked us. First thing you have to talk about how share option is to be dealt with. Then you have to talk about how deferred tax is to be dealt. So we can use a spreadsheet for all the number works. So we're doing, oops, what is this? Answer number A, and we're doing first part now. Answer number A1. What do we have to do? First part of the calculation will be around the share option scheme calculation, and the second part of our calculation will be around the deferred tax implication of share option scheme. Cool. So what do we have to do with the share options? What is the general accounting thing? We have this services going on. So when services going on, we are supposed to record some remuneration expense and show that in our financial statement. This is the key idea with share option calculation. Now this is a equity settled share based payment. So I have to focus on the fair value on grant date, that is equal to, what is the fair value on grant date? To fair value on grant date was 2.80. So that is equal to 2.80. Then what else do I need? We need the number of employees. We are going to calculate number of employees, the number of share options, possible chance of people going to take up, fair value at grant date, time period. Now expense recorded in first year, that was already given to us over here. Recorded in first year is expense correctly was recorded in the first year for 1.792 million. So that will be 1,792,000. Okay, what will be the expense to be recorded in second year? How do we calculate? We'll take the number of people. How much is that? 10,000 shares are given, 200 people are given, that one, and we're going to calculate on 2.80. And how many people are going to take it up? We're expecting 90% of people would take it up, and we are in the second year. So why is this gray color now? What happened? Okay, so 10,000 people multiplied by 10,000 options multiplied by 200 people multiplied by 90% of people I'm expecting to take it up, multiplied by 2.80, multiplied by, this is the second year out of 3 years of calculation, I mean 3 years of option. So this will give me the answer, that is Control C, Control V, and I'm just going to put an equal to sign in front of this. So we have 336,000, no, 3.36 million. Just for reference, I'll just write over here 3.36 million. Now this is the accumulated expense for the entire 2 years. What was recorded already in the first year? 1792. So what will be the expense to be recorded? This is the total expense for 2 years. So for this particular year alone, the expense would be equal to 3.36 million minus 1792 million is equal to 1.568 million. So we're going to pass the entry for this: debit, expense, credit, equity, because this is an equity settled share based payment. So debit, expense, credit, equity by 1568. Now what will be there in SOPL? SOPL will have an expense of 1568. What will be there in SOFP? SOFP will have last year's expense plus whatever expense came up in this year, which is total of 3.36 million. So that 3.36 million will be there in SOFP. This is our first part of the calculation around the share option scheme. Only this much is there. No more other complications were here. Second thing is the deferred tax implication. What is the deferred tax implication with regards to share option? It was mentioned specifically under IAS 12 that, and over here also in the books you can see over here. Where was it? Edison will benefit from tax relief on the transaction when share options are exercised. When will share options be exercised? 3 years later, meaning from the grant date. 3 years later only it will be exercised. But over that 3 years, I'm recording an expense. This remuneration expense I'm recording in first year, second year, third year also I'll record. But tax relief will come up only in the third year. So technically what's happening is, in the accounting books I am recording an expense, but in the tax books I am not recording an expense. Now what happens here? When expense is being recorded, profits will fall down. When profits will fall down, tax recorded will fall down. But on the other hand, in the tax books, because expenses are not there, profits will be comparatively higher. Hence, I will pay high tax. But what happens after 3 years when the tax relief is obtained, when that share options are exercised? Here, big expense will come up suddenly, because of which I will pay low tax. On the other hand, in the accounting books, because expense was recorded every 3 years, in that third year I'll have one small expense again for the third year, and I will have some tax recorded over here. So what's essentially happening over here is, the high tax that I am paying in the beginning is being set off by the low tax that I pay later on. What is this concept called as? Deferred tax asset. So the simple conclusion is, when a share option scheme is there, whenever a concept related to deferred tax comes up, this will lead to deferred tax asset. Now, the chapter itself teaches us a small proforma, like a small format on how to calculate this thing, where we assume the carrying value of this concept to be 0. Tax base we will calculate based on the final value, whatever is the tax figure over here. What was it? Some 3.36 million was there. This was the total expense calculated. So this 3.36 million was going to expense, but here they mentioned tax relief will be based on intrinsic value. So based on intrinsic value, we will find out what is the tax base. So I'll just write over here so we don't forget it. Where is Excel sheet? Tax base based on intrinsic value, and we're going to calculate that intrinsic value and find out what is the tax base. Then this tax base I'll multiply with the tax rate. I think that was 20%, no, 25%. So when I multiplied 25%, I'll get over here what is the deferred tax asset. So this will be the concept. Now what is intrinsic value? Intrinsic value, they told that it is the difference between exercise price and share option, exercise price and fair value of the share, when at 31st December X7. At 31st December X7, they told share option had a fair, shares had a fair value of 11.5. Exercise price was given somewhere over here, it is 8.5. So 11.5 minus 8.5 will be equal to 11.5 minus 8.5 will be equal to 3. 8, 11 minus 8 is 3. Yeah, 3. So here the calculation will be 200 shares are 200 managers are getting 10,000 shares multiplied by, there's a 90% chance that people would take it up, multiplied by $3 is the intrinsic value, multiplied by, we are in the second year out of third year. That will be equal to 360,000, no, 3.6 million, and deferred tax asset will be equal to 3.6 million into this one is equal to 900,000. Now this 900,000 is the deferred tax asset closing figure, because we took 2 by 3, which means this will be the final figure over here. Okay, now comes little more additional concept from the theory part. That is, it is said that if in case the expense that you're expecting to be recorded based on intrinsic value turns out to be greater than what you have recorded in SOPL as remuneration expense in the accrued total for 2 years, whatever is there in excess is supposed to go to equity and whatever remaining is supposed to go to SOPL. Maybe that statement might have confused you altogether. I'll just say once again. In the accounting books, what is the 2-year expense we have recorded? The 2-year expense was here based on that 2.80 for 2 by 3. 3.36 million is the total remuneration expense we have so far. What do we have in tax books? In tax book, based on the intrinsic value for second year, so far there should have been an expense. It's not there, but there should have been 3.6 million based on intrinsic value. So this is my expected figure over here. Now how much excess is there over here? 3.6 million is in excess of accounting books. So what we will do is, this 3.6 million, whatever is there, I am going to split it to 3.36 million and something extra. This 3.36 million part, which is related to remuneration expense, that deferred tax part will go to SOPL. Whatever extra part is there, that will go to equity. So in that case, how we will find out? We can just do the multiplication directly. This is 25 percentage, 25 percentage tax rate and 25 percentage tax rate. So the deferred tax of this one and the deferred tax of this one. So 900,000 we told is the total, but it should have been only 840,000 based on the remuneration expense. So how can I split that 900,000 deferred tax right now? 840,000 out of this, 840,000 out of this will go to SOPL. What is the remaining? 900 minus 840,000. 60,000 will be the extra equity part. Am I correct over here? With 60,000 excess part, I'm correct. But how about 840,000? Again, remember, this 900,000 is the figure for the entire 2 years. That means this 840,000 which goes to SOPL is for entire 2 years. We have a statement given at the last over here. After this expense recorded, it also correctly recorded that the deferred tax in relation to share option scheme was 104,000, which they have recorded in SOPL last year already. That means out of this 840,000, 104,000 was recorded already last year. That means how much will go to in the current year? If I minus out 104,000, we have 736,000 that will go to SOPL and the remaining will go to equity. This is the implication of the deferred tax asset that will be there. So finally, what will be there in SOFP altogether? In SOFP, there will be a deferred tax asset of 900,000 because that is the final figure. What will go to SOPL? 736,000, and here it will be 60,000. Okay, what goes to equity? So this will be SOPL income, so that's a credit entry. This is also a credit entry. The sum total of this will be the debit entry in SOFP because there is already 104,000. So that 104,000 on top of that, whatever for current year will get added on top of that, and it will be 900,000. So if you want the final balances, you can just write over here SOPL, this much will go, equity, this much will go. Final deferred tax asset in SOFP will be equal to 900,000. These will be the final balances. So now we have written all the numerical part with what happens with this calculation. Now we have to quickly make this into words as well. We're not going to think anything too much extra. Whatever numbers we have, we're just going to make it into words. Cool. So let's take up, where is our word processor? That's not mandatory. You have to do it in the Excel sheet. Okay, if you want to, just like how you would see in the exam kit solutions and all, if you want to write the number work here and write it accordingly, you can do it together as well. It's totally up to you. I'm just giving a technique. If in case you don't know how to structure your answer, you can do this. Cool. Okay, so answer number A1. What is answer number A1? About share option scheme. So we're going to first talk about the share option calculation. Then after that, we are going to talk about the deferred tax implication. What did we talk about the share option calculation first? It is an equity settled share based payment, and hence we are going to focus on the fair value of grant date for calculation purposes, which is $2.8. The situation is a equity settled share based payment, hence we focus on the, why is everything in bold right now? Hence we focus on the fair value at grant date for calculation of remuneration expense, which is $2.80. Next, what we told, expense recorded in first year is 1.792 million, or we can, okay, the expense already recorded in, okay, this is calculation, we just write, we focus on for which is $2.80. The remuneration expense is to be calculated for each year and split across the vesting period, even though the shares will only be exercised at end of 3 years. That was a little bit of the technical part we just mentioned. So we mentioned the technical part and the case study part. Now expense also expense recorded in first year, expense recorded in first year is $1.792 million. For the second year, we calculate the remuneration expense using the same fair value at grant date, but we reflect the estimated number of people that are going to vest, that are going to meet the vesting condition. Meaning we just explain the reason why 90% is going to be taken in the number over here. Hence, the remuneration expense for total 2 years would be how much? 3.36 million. You don't have to write the calculation all over once again, because we're going to write at the last. Refer to spreadsheet. So all the numbers are there. So we're going to just take the final figures over here. So that will be equal to 3 would be $3.36 million. Hence, in second year, the difference of $3.36 million, and, or you can just write, hence in second year, a remuneration expense of 1.568 million. Okay, of 1.568 million. How did we get 1.568 million? 3.36 million minus, not necessary to write that, dollar 1.792 million. Hence, in second year, a remuneration expense of 1.568 million will be shown in SOPL, while the equity section in SOFP will show the total of $3.36 million. That was the explanation for this one. Where is it? SOPL will show this much, SOFP will show this much. So we're done with the first part of our explanation. What is the second part? Deferred tax implication. What were the two concepts we mentioned over here? Um, Share option scheme attracts tax relief only in the year where share options are exercised, while remuneration expenses are recorded all over the vesting period. This leads to a situation where temporary differences arise, causing a deferred tax asset to be recognized. So, what did we explain now? We explained this part, the explanation that I gave. Why do we have a deferred tax asset? Done. Now, the tax base of the expected tax relief in future is calculated on the basis of intrinsic value, that is difference of market value minus exercise price. This intrinsic value is used to obtain the tax relief, which when multiplied with tax rate will obtain the deferred tax asset. The carrying value in financial statements is considered to be nil or zero. So what did we just explain? We explained this part, meaning how the format works. So using a $3 intrinsic value, how did we get $3 intrinsic value? $11.5 minus $8.5. We get the tax base equal to, how much is tax base? 3.6 million. $3.6 million and no, $3.6 million, and multiplying with 25% tax rate obtains a deferred tax asset of 900,000. 900,000. Now we explain the numerical bit. Okay, so this calculation we explained. Then what we explained, the concept over here of separating this thing. So what was the concept? If the expected, as per accounting rules, as per accounting standards, if the expected tax relief based on intrinsic value turns out to be greater than remuneration expense in SOPL, the total expense or the total deferred tax is to be split between two parts, where deferred tax asset related to remuneration expense will be shown in SOPL, while the excess will be shown in equity. So what did we explain? We explained the theoretical concept behind these numbers. Now we show the numerical part. The difference between the expenses in or this difference between the expenses in tax books, or you can say the difference between the estimated tax relief and remuneration expense is dollar 60,000. How did we get 60,000? That is a difference of dollar 900k minus dollar 840k. Okay, this excess figure will be shown in equity. What about the remaining thing? From 840, what did we do? From 840, we deducted 104,000. As dollar 104,000 was already recorded as deferred tax asset in the first year, the remaining figure of how much was it? 736,000. 736,000 will be shown in SOPL. How did we get 736,000? That is dollar 840,000 minus dollar 104,000. Correct, right? 840 minus 104. So 840 minus 104. So what we explained? We explained how we got these two numbers as well. What is this thing? Final figure in SOFP. So we can just say that the final SOFP balance for deferred tax asset will show the total of dollar 900k. So what did we do here? Exactly whatever we did in the numerical part, we just explained into words. We just use the technical part we know from the accounting knowledge, because that's how we got these numbers. Same thing we wrote in words as well. So we have the technical part, we have the case study part, we have the number work here. We didn't bluff anything, and we can just write over here in the beginning itself if you want, or at last, anywhere you can write. Refer to spreadsheet for all detailed calculations, and make sure that you're doing the calculations also little neatly, because we're not showing the much of the calculation bits over here in our word. So when you're showing it in the spreadsheet, do it a little properly so that the examiner gets to understand that you didn't copy it from anywhere, you actually calculated and got those things, so they can actually track everything from here. Cool. So that was the first question for 12 marks. That is done. Next thing, they're asking critically discuss whether deferred tax balance recognized in relation to the share option scheme reflects the definition of elements provided in the conceptual framework for financial reporting. Now, they want specifically regarding deferred tax balance recognized in relation to this. So, what did we recognize? We recognized a deferred tax asset. So, this deferred tax asset, whether it is meeting the definition of element. So, which element should we talk about? Asset, because deferred tax asset is recorded under non-current assets. So, the question is asking, as per conceptual framework, as per the definition of asset, is the deferred tax asset meeting that or not? So, where we have to start with, we have to talk about what is an asset as per the conceptual framework, then try drilling down and figuring out whether it is correct or not. Cool. So, this has nothing to do with the number work. So, you can just close the Excel sheet. So this is like a pure theory question. Let's start. Share option calculation. Okay. As per conceptual framework, the definition of asset is a present economic resource controlled by the entity as a result of past event. So it is there as a present economic resource. It is controlled by the entity and it is there with you as a result of past event. Okay, done. Now, what does economic resource mean? If you want, you can just write over here. Economic resource means potentially can gain some economic benefits. Okay. So this is like the basic idea behind what is asset mean as per conceptual framework. Now I have to drill down, and this will give you only 1 marks. Now I have to drill down and figure out whether it's meeting deferred tax asset or not. How we can look that? Find out each keywords from this and see whether it is matching or not. For example, whether it is a present economic resource or not. Or first see whether it is a present resource or not. Second, whether it is an economic resource. Will you get any favorable benefits from this? Third thing, as a result of past event, meaning something in the past did you do in order to get this asset. So we have 3 points. Let's assume like for each 3 point we're getting one mark. So like that we can structure it and start figuring out whether it is going to meet the conditions or not. First thing we can talk about present, whether you have it now or not. um, to understand whether if whether to understand whether deferred tax asset meets the definition of asset as per conceptual framework, following things can be considered. Number 1, present resource. Now either you can write as bullet points or you can just write as paragraphs. Okay, so present resource, if I have to have it in present with me, I should have done something in the past so that I get it. Okay, considering over here deferred tax as a concept, it is there only in my accounting books. Am I eligible to get this, or am I actually in control of this? Is this an asset for me as of now? No. This will become an asset for me when, after third year, when I get the actual tax relief, it will become an asset, because there I will get the economic resource, that benefit. So getting that economic benefit happens only in third year. But today will I get anything? No. So as of now, is it a present resource for me? No. So I can say that the tax relief obtained from exercising shares is the reason why deferred tax asset is recorded. This tax relief as an asset or as a benefit will only be obtained or benefited after third year if directors exercise these options. Hence, presently it is not a resource for company. Cool. So we explained why it's not a present resource. Next thing, economic resource. Economic resource means potentially gaining some economic benefits. Economic resource. The potential benefit to gain from deferred tax asset recognition is the tax relief if directors exercise these options. Hence, as it is a condition based, and hence as it is a condition based asset, meaning it's a tax relief only if they exercise it, so it's based on a condition. Hence, as it is a condition based asset, this can be connected to contingent assets which cannot be recorded within financial statements. So second point is also out. What is third point? Controlled by the entity, or you can say about the past event. Now let's, since we told the present resource kind of connected to that past event, I can talk about the controlled by entity. Control means that Edison company should have the power to direct and completely enjoy the economic benefit from this. Considering that the asset, or considering that the benefit here is at the will of directors exercising the share options or not, Edison company doesn't exactly control the asset over here. Considering a negative outcome in all above matters, it can be concluded that deferred tax asset don't meet the criteria or don't meet the definition of an asset. Khalas. So that will be the explanation for this 4-mark question. Alright. So we're done with the first 16 marks part. Let's move to the next question over here. Where is it? Over here. Using exhibit 2 in accordance with IFRS. Now let's figure out what to do over here. This is 6 marks and this is 3 marks, so we're not going to have much lengthy calculations or discussions over here. So explain how Edison company should account for its investment in Lupton and the related deferred tax again. Okay, we have a deferred tax over here and investment in Lupton, 6 marks. So we can just split it partially, like, investment part we're going to talk about 3 marks, deferred tax 3 marks. So it's not going to be much difficult. Then some 3-mark discussion is also there that we'll see later on. Okay, so about exhibit 2, let's see what is here. On 1st September 20X7, Edison acquired a 40% shareholding. 1st September X7 means current year itself, September, October, November, December. So 4 months time period. Edison acquired a 40% shareholding in Lupton for 13.9 million. So that's the cost. On this date, fair value of Lupton, I'll just use my spreadsheet. Then on this day, the fair value of Lupton's identifiable assets and liabilities was 38 million. Okay, so I'll just write, where is, not this one, this one. Answer B. We are doing answer B1. What is B1? Accounting for investment in Lupton. Now, what was the main thing to consider over here? First thing, we got the cost, that was 13.9 million. Then they told the identifiable net asset is 38 million. So net assets are 38 million. We are acquiring 40% of that. So 40% of the net asset will be equal to 38 million. No, 40% of 38 million is 15.2 million. Oh, you can find over here that net asset is 15.2 million and the cost is only 13.9 million. So you're doing like a bargain purchase over here. Whenever you have a bargain purchase situation, that will be part of the income. How much income will be there? Just write over here, like a bargain purchase, there will be a gain of 1.3 million. This will go to SOPL as an income. Okay, let's continue. Then, which was equal to the carrying amount in Lupton's individual financial statement. So there's no difference between the fair value and carrying value. Cool. Edison has representation on the Lupton's board of director and has determined that Lupton is an associate. So we follow equity accounting. Edison participates in operating and financial decisions about Lupton, but does not determine the company's dividend policy, which just shows that you don't have a control over that. You just have a, what do you call, significant influence over that. In the year ended 31st December X7, Lupton made profits of 5.1 million and had no other comprehensive income. So associates profit for the entire year is 51 million. No, 5.1 million. 5.1 million. What will be your share in this? 5.1 million. 5.1 million multiplied by, you have 40% shareholding, multiplied by this company was there with you only by 4 months. So 0.68 million will be the share of profit from associate. Relevant tax rate is 25%. That is probably for the deferred tax part. If Edison disposes of its investment in Lupton, it will receive a tax deduction equal to 13.9 million purchase cost. 13 point, okay, 13.9 million is the cost of investment. So you'll get the complete tax deduction on this. So this we are going to use like the tax base, and we'll see what is there in the carrying value of financial statement. So cost is 13.9 million. Net assets gain we found out 1.3 million. Share of associates profit is 0.68 million. So the of carrying value of investment in SOFP will be equal to 13.9 million plus 1.3 million plus 0.68 million. That was straightforward. 15.88 million will be there in my SOFP. Okay, so I'll just write over here. This will be there in my SOFP. So that accounting was simple. What is the second part of the accounting? Second part of the accounting is deferred tax implication. What is a deferred tax implication? In the concept again, I think under in the same taxation chapter itself, there's a concept where they talk about the deferred tax implication when there is a, what do you call, like business combinations. So in business combination where all deferred tax implication comes up. Here what is the implication? Here the implication is, in the accounting books we calculated now the investment, the carrying value of investment and everything. So this is an associate. So in the accounting books we followed the equity accounting, and we found out the carrying value to be 15.88 million. But it is said over here that if in case I'm selling this investment, okay, this 15.88 million item in my SOFP, when I'm selling this, I will get a tax relief of only 13.9 million. That means in my tax books, the tax base I can use is only 13.9 million. So there came a temporary difference over here. What kind of temporary difference came up over here? A temporary difference where my carrying value turns out to be greater than my tax base. What will this lead to? This will lead to a difference between this. What kind of difference? A taxable temporary difference, which means this temporary difference, when I multiply it with the 25% tax rate, I will get a deferred tax liability equal to difference into 25 equal to 0.495. So here we have 0.495 means 495,000 deferred tax liability will be there. Considering that they didn't mention anything about previously if something was recorded or not, we can say that this 495,000 can be recorded in full itself. That means debit SOPL as an expense, credit SOFP as a liability. So I'll just write over here as a liability, and this will be as a expense. That will be equal to 495,000 and 495,000. This will be my final entries that we'll have to do. Now, just to add on one additional point, whether we should record the deferred tax or not. Okay, if in the textbook, if you have gone through these points, the rule for recording a deferred tax in the first place. Now, first thing is, what is the concept behind? How will this get cleared? This deferred tax liability will be cleared when, after a point, what is the accounting treatment over here? When will this go down? Like now it is carrying value greater than tax base. That's why it is a deferred tax liability. That means if this has to be reversed, this needs to reach a situation where carrying value is less than tax base. When will that situation come up? When your carrying value falls down. In the investment in associate, when will the investment fall down? When will the carrying value fall down? When there is a reduction in the equity value of that associate. When will the associate's equity value fall down? When they pay out dividends to me, that is the parent company, to Edison company. So when dividends are paid out someday in future, there will be a drop in the carrying value, and when that drop happens, this deferred tax liability will reverse and turn out to be zero. So this is how the concept will work. Next thing, IAS 12 says that This deferred tax can be recorded only in condition where, I mean, generally you have to record, but it should not be recorded. Okay, that was the condition. It should not be recorded. It's not to be written over here. I'm just giving some knowledge. It should not be recorded if situation number one, you can control this particular dividends. Meaning, if you are the one who is controlling the dividends, that means you should not be recording it. Which means when it's an investment in subsidiary, you generally have a control over that company, which means you have the control over when the dividends should be paid and how much it should be paid. In that case, generally when it's an investment in subsidiary, you will not have a deferred tax implication like this. But when it is an investment in associate or an investment in joint venture, you don't have a control over there, you have only a significant influence. It is also mentioned over here, the company does not determine the company's dividend policy. So you're not involved in making the dividend policy. So you don't have control over that. So when you don't have a control over that, you can record it. When you have a control over that, you're not going to record it. So here, this is the key concept we are going to bring when we are discussing the points. Because the company is not controlling the dividend policy and hence the control is not with them, they are good to go with recording a deferred tax. Cool. Now we're done with the calculation bits. Hope you have understood the accounting part and all. Now let's write the stories for this. Word processor. Just remember this is for 6 marks, so we're not going to expand it too much. First thing about accounting for investment in, what was the company's name? Lupton. Okay. Investment in Lupton. The investment in Lupton company shows that they have a significant influence in participating over financial and operating decision making. Hence, we follow equity accounting for associates. What is equity accounting? Equity accounting is done by initially recording at cost of investment, further adjusting it with parents' share of post acquisition profits or losses made by the associate. So we told what is what accounting we are going to follow and how is equity accounting done. Now, what was the calculations we did over here? One thing, we can just copy paste this thing over here. The initial cost of investment dollar 13.9 million when added to profits made in post acquisition period of how much was it, 0.68 of dollars 0.68 million. How did we get that? Oh, what did I copy? It's not coming out. Okay, forget it. When added to profits made in post acquisition period of 0.6 million and adding the gain made over bargain purchase by paying less than share of net assets by 1.3 million, the carrying value of investment turns out to be $15.88 million. So that is enough. Next thing is about deferred tax implication. As the carrying value is $15.88 million, while the carrying value is 15.88 million, while the tax base is $13.9 million. This leads to a taxable temporary difference, which further on multiplying with tax rate leads to a deferred tax liability of, how much was it? We found the taxable temporary difference. When multiplied, we got 495,000 of 490 90 or 95, 495,000. Okay, dollar 495,000. Hence we charge this to, no, what was the rules we told? As per IAS 12, a deferred tax in this situation can be recognized when, no, cannot be recognized when investor controls the timing and payout of dividend payment. It is mentioned within case study that Edison company doesn't control the dividend policy and is only being part of operating and financing decision making. Hence, this $495,000 can be recorded as a deferred tax liability. Where did we get all these numbers from? Refer to spreadsheet for detailed calculations. Cool. So we're done with 6 marks. Now we have a 3 mark discussion over here. What was this about? Where is the question? Oh, over here. Critically discuss. Now we can remove this. Critically discuss whether deferred tax balance recognized in relation to the investment is reflecting the definition of element. Okay, again the same question like previous one. Here we recorded deferred tax liability. So what element we are going to connect to liability? As per conceptual framework, liability means a present obligation to transfer economic resource to another party based on past events. So due to something that happened in the past, I have a present obligation to transfer economic resource to another party. So three things I can connect over here based on past event. Do we have something? Present obligation. Should I pay something today? Transfer economic resource. Should I give something to someone? Cool. So either I can connect one by one, or let's try a different method. This time we'll just go with paragraphs and see how we can frame the answer. Okay, last time we did point by point. Let's see with the paragraph how we can write. So where do we start with? This is a deferred tax liability, and we told this deferred earlier. We told deferred tax liability will turn out to be like a zero case means this liability has to be cleared at some point, then only it will be reversed. When will this be cleared? As I told earlier, only when this associate company pays out the dividends. So when they pay out a dividend, deferred tax liability will be cleared. So if they don't pay out a dividend, that deferred tax liability will stay as it is. That means today, do I have to pay something to someone? No. If they pay out the dividends today, that deferred tax liability will be cleared. If they don't pay out anything, or as of today, since they have not paid anything, I don't have a present obligation towards anyone, because there's two things. Present obligation means legal obligation, or what is the other one? Legal obligation or contractual obligation? No. Constructive obligation. Now, legal obligation and constructive obligation. Legal obligation means by law I have to pay someone. Here, by law I don't have to pay anything. Second is constructive obligation, when someone else is expecting something from me as a payment. Is there anyone on the other hand who is waiting for a payment from me? No. So there is no another party who is waiting for my payment or anything. So present obligation is strictly not there. Let's frame that point. Present obligation means I have to pay someone based on legal or constructive obligation. Here, an obligation to pay taxes arise only when the dividends are paid out by the associate company, where deferred tax liability would reverse. As currently there are no dividends paid out, Edison company have no present obligation to settle any liabilities. So present obligation is out. Do we have any other party who is waiting? No. Considering there is no legal or constructive obligation here, we can conclude that there is no other party today or at year end waiting for this payment from Edison company. So there is no other party either. Is there any past event that is causing this obligation today? No. First of all, there is no obligation today. Second thing, there is no past event that's causing this obligation. This will become an obligation for me in future when dividends pay out. Okay. As mentioned above, the present, as mentioned above, this becomes an obligation only when dividends are paid out in future. Hence, there is no past event that is creating an obligation today. Kind of mismatch it is. The statement should have come a little earlier over here, but that's okay. Anyways, content is there because we told about dividends payout and things, and it's like a continuation. Second paragraph should be this, and third paragraph should be this. That is okay. Anyways, the contents are there, so that is fine. So as mentioned above, so and so things and all happened. So hence, so we mentioned 3 points over here, and that was enough. This is for 3 marks. Hence, the deferred tax liability doesn't meet the definition. Hence, deferred tax liability doesn't meet the definition for liabilities as per conceptual framework. And with that, we wind up this 25 mark question. Hope you have followed with all the techniques that we have used in how to write and frame our answers. And as I said, it's not mandatory that you have to use these same techniques. You can always try out different things, maybe other techniques that you have learned from your end or from the exam kit. The model where you don't use the spreadsheet at all and you write all the numericals over here, anything is totally possible. Or you can even start off writing the answers along doing the case study also while reading. You can mark down the points and start writing, framing the answer. Anything is possible. So this is just one another technique that you can use if in case you don't have a clear structure on how to go about. So hope this question was clear and how we have solved all the answers and the extra knowledge we have shared about the IFRS part. Hope all of this is clear. So do let us know which part of this video and what concept out of this has helped you in your SBR preparations. We have one last question remaining in this particular exam, that is question number 4 for section B. So see you in the next video.